Picture this. You're sitting in a room with a bunch of finance bros. They're throwing around terms like PE ratios, dividend yields, market caps. Your eyes glaze over. You nod along, but inside you're thinking, what the hell are they talking about? Here's the secret. They're basically talking about French fries. No, seriously. By the end of this story, you'll understand stocks better than most people who pretend they know what they're doing. And we're going to do it with a single McDonald's French fry. Let me tell you a story about two brothers in 1940. They had a tiny burger stand in California. Nothing special, just two guys flipping burgers. Fast forward to today. McDonald's feeds 69 million people every single day. That's like feeding the entire population of the UK. Breakfast, lunch, and dinner. Now imagine if McDonald's was one gigantic order of French fries. We're talking about a mountain of fries worth $200 billion. That's billion with a B. But here's the problem the McDonald's brothers faced. They couldn't build this empire alone. They needed money, lots of it, more than any bank would lend them. So they did something brilliant. They said, what if we let ordinary people own tiny pieces of our company? They give us money to grow, and in return, they get to own a piece of everything we build. And that, my friend, is exactly what a stock is. So McDonald's took their entire company, every restaurant, every Happy Meal toy, every golden arch, and divided it into 742 million pieces. Think about that. 742 million pieces. Each piece is called a share. Why? Because you're literally sharing ownership of the company with 742 million other pieces. Here's what blows people's minds. When you buy one share of McDonald's for about $170, you actually own part of McDonald's. Not borrowing, not renting, owning. You own a tiny piece of all 40,000 McDonald's restaurants around the world.
Every time someone in Tokyo orders a Big Mac, every time someone in Paris grabs a coffee, every time someone in New York gets nuggets, you own a microscopic piece of that sale. It's like owning one single French fry from the world's largest order of fries. Your fry is small, but it's absolutely yours. Now here's where the story gets interesting. Wall Street guys love making this sound complicated. You know why? Because if it sounds complicated, you'll pay them to manage it for you. They'll say things like equity position instead of stuff you own. They'll say capital appreciation instead of your stuff became worth more. They'll say portfolio diversification instead of don't put all your eggs in one basket. It's like calling a hamburger a thermally processed protein disk in a wheat-based containment system. It's still just a burger. I had a friend who wanted to invest for 5 years but never started because she thought she wasn't smart enough. Then I explained it using this French fries story. She bought her first stock that same day. She texted me 6 months later, "My fry is worth $200 now?" That's when I realized the problem isn't that investing is hard. The problem is that nobody explains it in normal English. So you bought your McDonald's fry for $170. How does this tiny fry actually make you money? There are only two ways. That's it, just two. First way, your fry becomes more valuable. Remember when a burger cost $1 in the 90s? Now it's $5. Same thing happens with stocks. McDonald's grows, opens more restaurants, creates the next viral menu item. Suddenly, everyone wants McDonald's stock. Your $170 fry is now worth $200. You made $30 by sitting on your couch watching Netflix. Second way, McDonald's pays you just for owning the fry. 4 times a year, McDonald's literally sends money to everyone who owns shares. They call this a dividend, but think of it as a thank you for believing in us payment. Own 1 share? You get about $6.68 per year. Own 100 shares? That's $668 per year. My neighbor bought 500 McDonald's shares 20 years ago. She now gets $3,340 every year just for owning them. She calls it her McDonald's vacation fund because that dividend money pays for her annual trip to Hawaii.
Let me tell you about Sarah. She's 25, works in marketing, and always thought investing was for rich people or math geniuses. One day, she downloaded Robinhood just to see what it was about. She noticed she could buy stocks for as little as $1. She thought it had to be a mistake. She took $170 from her tax refund, money she was going to spend on shoes anyway, and bought 1 share of McDonald's. 6 months later, her share was worth $185. Plus, she'd received 2 dividend payments totaling $3.34. She had made $18.34 by doing absolutely nothing. That's when it clicked for her. The stock market isn't some exclusive club. It's just people buying and selling pieces of companies, and anyone with a smartphone and a dollar can join. The biggest lie about investing? That you need to be rich to start. You don't. You just need to start. But here's the real story nobody tells you. It's not about making $18 on one share. It's about time. Let me blow your mind with some math. If you invest just $100 a month starting at age 25 and the market grows at its historical average of 10% per year, you'll have about $632,000 by age 65. You only put in $48,000 of your own money. The rest? That's your money making money, which then makes more money. My uncle started investing $50 a month when he was 22. Just $50. He's 62 now and has $1.2 million from $50 a month.
But his brother said investing was too risky and kept everything in a savings account. He has $24,000. Same amount saved. One is a millionaire, one is not. The only difference? One bought fries, one didn't. So you're convinced. You want to buy your first fry. Here's exactly what to do. First, don't overthink the app. Fidelity, Schwab, Robinhood, they're all fine. It's like choosing between Uber and Lyft. Pick one and move on. Second, start with $100, not $1,000. Just $100 you won't need for a year. Think of it as tuition for the best financial education you'll ever get. Third, don't try to pick the perfect stock. Start with something called VOO. It's basically a basket that owns pieces of the 500 biggest companies in America. One click, and you own a tiny piece of Apple, Microsoft, Amazon, and yes, McDonald's. Fourth, and this is crucial, set up automatic investing. $100 a month every single month. Make it automatic so you don't have to think about it. The best investors aren't the smartest, they're the most consistent.
And here's what not to do. Don't check it every day. Don't panic when it goes down. And don't wait for the perfect moment. The perfect moment was yesterday. The second best moment is today. I know what you're thinking. What if I lose money? You might. In fact, you probably will. At first, the market goes up and down. But here's the thing. In its entire history, the stock market has always gone up over time. Every crash, every recession, every pandemic, the market recovered and went higher. My first investment dropped 20% in the first month. I almost sold everything. Thank God I didn't. That investment is up 300% now. The scariest part isn't losing money. The scariest part is being 65 and realizing you missed out on decades of growth because you were too afraid to start. Look, every expert investor started exactly where you are right now. Confused, a little scared, wondering if they were making the right choice. The difference between them and everyone else? They bought their first fry. Your future self is begging you to start today. Not tomorrow, not next month, today. Because in investing, the most powerful force isn't knowledge, it's time. And every day you wait is a day of growth you will never get back. So stop waiting to understand everything. Stop waiting for the perfect time. Just buy your first fry.